Hello and welcome to the latest instalment of MFS's Let's Talk Property podcast, where we connect with industry experts to explore an array of topics within the dynamic world of property. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. MFS are a bridging loan and buy-to-let mortgage provider and are not financial advisors. The opinions and views expressed in this episode are personal to the host and the guests and may not reflect the views of MFS. For more information on MFS, you can find us at www.mfsuk.com and be sure to keep up with our podcast updates on Instagram at MFS_LTP. Now let's get started. Welcome back to episode 4 of a Let's Talk Property podcast in association with Market Financial Solutions. Today we are joined by the Sales and Commercial Director for Aria Finance, Mr. Joe Aston.
Yeah, thanks. Aria Finance.
Aria, apologies. Joe, we're going to be hitting some hard-hitting topics today, changes in specialist lending, landlord habits, and the evolution of the mortgage broker. But before we go into those areas, it'd be very nice to hear a little bit about your business and yourself. So, for anyone who might not know you, Joe, can you give us a quick intro and what your role in Aria involves?
Yeah, happily. So, I mean, we're by trade, we're a master broker.
Yep.
80% of what we do comes from other mortgage brokers in the market. Sort of our distribution is far and wide. We've been around for 23 years. The firm is the coming together of two brokerages back in 2022. We transact we successfully drew down about £500 million worth of specialist finance last year. So,
Okay.
You know, we're a sizable player in the market, we like to think at least. We span across a number of different products, regulated and unregulated, and that's us.
Cool. You've mentioned the merger of two brokerages. What drove that decision and has it changed the way you work with your clients?
Yeah, I'm not sure it's wholly changed the way we work with our clients. We were two competing brokerages owned by the same group, so
Okay.
Vantage Finance and Enterprise Finance. And honestly, we were sort of two sides of the same coin. Enterprise was one of the early pioneers of second charge mortgages, had a good bridging distribution, smaller on the buy-to-let and commercial side. On the flip side, Vantage was one of the market leaders for commercial and buy-to-let, a good bridging proposition and much smaller with second charges. So by coming together, you know, we've strengthened each division.
You've covered all areas.
Sort of an
really.
equal measure, yeah. So we like to think we're pretty well rounded now.
Okay. The specialist finance market has shifted quite a bit lately. What changes have you seen over the past year or so in terms of deal flow or borrower needs?
I think the change in profile is there's a couple of different ways that specialist lending has changed. Firstly, I think the bar for specialists has gone higher. You still have sort of high street banks describing their specialist proposition and it's self-employed mortgages. And that's not specialist anymore for me. That's as mainstream as it gets now. So I think the bar has moved for what specialist looks like. And then I think people who are truly in the specialist borrowing market, their needs have changed again to go beyond standard rate card. I think we live in the grey more now than we did 2 years ago, sort of pre-mini budget mortgage crisis. But I think that's probably testament to the resilience of the private rental sector. Landlords are agile, right? So where standard AST buy-to-let has not produced the same sort of yield and actually that market has been squeezed, people are pivoting on the spot to whatever strategy fits them, right? They're going into bridging, to refurb, to below market value, to auctions. They're looking at social housing, rent to rent, holiday lets. And with sort of an increased volume of appetite for borrowing, lenders have to adapt and react. So
I completely agree. We'll come on to social housing a bit later on actually, because it's a topic I talk a lot to my brokers about. I see that as one of the next biggest areas for landlords who are interested in larger properties like HMOs and multi-units. We'll come on to that a little bit later. But in regards to the changes of specialist lending, are you seeing different types of inquiries coming through now compared to, say, 12 months ago? How are you responding to these types of changes?
Yeah, I think yes and no. I think it's the borrower's attitude as to whether they actually take the debt or not. You know, you go back again to Q4 22 following the mini budget, regardless of political persuasion, which was a disaster. And actually, I'd go to trade shows and I'd give talks and people would come up to me and say, rates are about to drop, so I'm going to hang on. And rates are about to drop and they're going to drop and I'll just wait a bit longer. And here we are 2 years later, 2.5 years later, and rates haven't dropped, not properly.
No.
So I think the borrowers now are adopting and embracing the new normal, and I think are finding properties and yields and return that work for them in today's market.
Yeah.
So I think the attitude towards borrowing hasn't changed. They may be a bit more cautious. People like to know a project is going to work for them.
Yeah.
But from an inquiry perspective, it's just specialist lending. It's people looking at different forms of buy-to-let, long-term investments or short-term strategy, whether it's for retention or sale. So, it's much the same. It's just trickier, I think, to convert that business from a broker's perspective and to help a client get comfortable with transacting on the spot, not waiting for this promised better day.
There's always something around the corner why potential landlords want to wait.
Yeah.
And they don't commit, don't they? Whether it's a price change or criteria change or regulation change. Absolutely right. Let's take a slight change and shift here, more towards lenders now. Has the appetite from lenders shifted at all this year? Are you seeing more innovation or more caution in how deals are being looked at?
Yeah, I think the lending market has done really well, to be honest with you. Again, you sort of go back to that 23 year that was really, really tough. Yeah. Immediately the market innovated. It's different to 2008 when there was a liquidity issue. Yeah. People had the money and wanted to lend, but it's finding the right price point, the right deal structure, the right appetite without incurring more risk. The lending market really quickly brought in the high arrangement fee, lower interest rate products that, although it took, I think, borrowers and still does to an extent, a little bit of time to get the head round, ultimately it's there as a leverage aid, not just to make more money from the transaction. When you amortise the costs over the 5-year period or whatever the fixed rate is, it comes out to the same thing. So I think that was a great piece of innovation that has really helped the market, particularly the remortgage. It's helped a lot of landlords stay in the game, having spent the last 15 years leveraging the hell out of their portfolio. But then I think you get more creative. Again, I think, the last 12 months, if I get more specific, I think people are trying really hard. I don't know whether we've got the perfect products out there yet, but, deferred interest was brought back in briefly by Market Financial Solutions. You saw these hybrid 2-year products with bridge to term, bridge fusion. Actually, there are now some new products coming out as well that are part and part serviced and retained interest as well. So people are trying, I think. I would like to see stress test reform. I think the stress tests are maybe a little inappropriate now. They've done a phenomenal job of protecting the lending space. Yeah,
I think, are you talking more about the residential side, affordability stress testing, or the buy-to-let side?
I'm talking about buy-to-let. I'm talking about stress testing of rental income to protect the lenders. So, you have lenders who spent years transacting with 190% cover because it was never challenged, because it didn't matter. When interest rates were 2 to 3%, rent was fitting, it didn't matter. But what they did was they protected those lenders from going under in the crash. But actually now, is it appropriate with rates where they are to still stress test it quite as aggressively? Right. I'm not convinced.
Yeah, no, absolutely. Going back to your company, and with the changes that we've talked about, have you and your team had to adapt your approach to keep up with the market and your clients, so to speak?
I think so. I think we've had to work more collaboratively within divisions. I think the divisions are closer aligned than they ever have been before. We've seen a huge increase in regulated bridging, and actually, if you're going to do reg bridging really well, it's really nice to have a good link with our residential divisions. We've seen people leveraging through second charges to raise deposits to buy more investment property, because actually they don't have enough cash anymore. They need to deleverage a little bit. We've seen people pivoting on what sort of their buy-to-let strategy is and how to approach that. So I think firstly, communicating across products and everyone having an understanding of where we can help is important. But I think the other way is probably taking a step back from, again, rate card broking. I think the mistake people make is looking at, and for a lot of brokers who are entering the specialist lending market, you can't look at a rate card the same way you can a high street residential mortgage. It's not black and white. The beauty of our sector and the beauty of a good lending business and a good broker is that they live and operate in the grey area between what can and can't be done.
And there's landlords that will always look at the highlights of the rates and go, why can't you get me that HSBC 3.5% rate? It's like, well, your situation doesn't really conform to that. That's always a challenge.
And that's more widespread than you think, because as soon as you get anywhere near the high net worth space, or you go into sort of larger loan realm, they don't ever fit criteria, they don't ever fit a rate card, but that doesn't mean they're not grade A borrowers, great assets
Absolutely
and
right.
good opportunities to lend. So it's about, as a broker, identifying where is the risk and where is the problem versus criteria, and have I already found the mitigant?
Yep.
And can I give that to the lender at day one so that you're not waiting for an underwriter to find the problem?
You've mentioned large loans, high net worth clients. What's different when you're transacting on a large loan deal? Where can brokers, in connection with that, where can brokers really add value in those kind of deals? What should their focus be?
I think there's a number of things. I mean, again, first and foremost, the large loans never fit a box, right? They live completely in isolation. Every deal is different.
Yes.
And the higher value borrower, the more weird and wonderful strategies they've tried, explored, succeeded with, failed with, different tax advice, different company structures, and you end up finding something new on every deal that you might not have seen before, and that's a really good thing, but you have to embrace that with a lender and not try and hide things or shy away from them. Embrace those challenges and pick up the phone. I think the biggest mistake you can make getting into the large loan space is, again, working through a piece of paper and saying this fits with this lender or doesn't. Pick up the phone if you think it's a good deal and a good borrower, and call somebody with a credit mandate or the ability to make a decision within that lender and see if they fancy it.
I think you're absolutely right. Communication is key, with the relationship with the customer, the broker, the lender, the decision maker, the credit policy team, especially on those large loan deals. Everyone joined up together, I think, is absolutely key. We're going to stick with the high net worth. Just one last question on that. With high net worth customers, they're often more complex incomes and asset structures. What do brokers need to get right when they're presenting these cases, do you think?
I think getting to know the borrower before they approach the lender is important.
Yeah.
You see the odd large loan that's been shopped around a bit, and we could call you guys to talk about it. You've seen it 3 times before. And the interesting thing, whenever we see a deal like that that's gone around a bit, is the lender has had it presented differently by every broker. Now, someone's right,
yes,
and the others are wrong, and it's hard to know who's got that. And I think the only way the best chance of success on presenting a loan is by really knowing the loan and knowing the deal. And if you haven't taken the time to get into the detail up front and get to know the borrower and get to know what their motivations are for structuring a deal like XYZ, I don't think you can really fight for it. I think you have to believe in it, and you have to know it to believe in it.
And really work on it as well.
Yeah, for sure.
In regards to loan sizes, is there too much focus from brokers on chasing the big deals, do you think? What should brokers and lenders actually be paying attention to?
I think there is a lot of focus on numbers, but also, I mean, I get it, because we all
we're here
work,
to get paid, aren't we?
Yeah, we all work to, and sometimes it's not even just earnings, they're statement cases, landmark wins, things you can really hang your hat on and shout about, and they're the thrill of completing a large loan is something I still enjoy personally, not just us as a firm. So I get it. But I think maybe the mistake, and we do see brokers bringing larger loans to us where they've given it a bash and maybe got it wrong, and not understanding that they've really hampered the cause there a little bit by that delay or just annoying the customer as well.
Dare I say it, maybe a little bit out of their depth.
Yeah,
sometimes.
Look, I think for sure, and that's said with no disrespect.
Absolutely.
You can have fantastic firms transacting 800-900 million a year in residential mortgages. That doesn't mean they can go and do a complex multi-unit with an offshore ownership structure. But utilising the right support just to get the deal done is probably the key. Yeah,
no, absolutely right. I just want to go back to the point I raised a little bit earlier on with the Renters' Rights Act that's coming in this year. Do you believe that landlords might want to focus on different tenancy arrangements, so short-term lets, corporate lets, holiday lets? There could be an evolution of supportive living, or what you'd class as vulnerable tenant setup.
Yeah.
Could you see maybe an evolution of that, landlords who are interested in large HMOs or multi-units don't necessarily want the grief of the AST setup? Is this something they could consider going forward?
100%. I think I do quite a lot of the landlord sort of road shows and do a lot of speaking at those events, and I sort of bang the drum, and I'm a real champion for the professional landlord. Yeah. And I think we're living in an environment when there's a rise of the professional landlord, and you hear about the buy-to-let exodus in the market. I'm not sure that's quite true. I think those are the armchair landlords and the accidental landlords who their right to get out when there's more legislation coming in. The Renters Reform Act as well, as scary as it is, there's a lot of doom mongering about it.
Yeah.
But if you're a responsible landlord, you have a good managing agent.
You shouldn't have nothing to worry about.
I sort of think so, right? And it hasn't gone through Lords yet. And even if it does, you're looking at the end of the year for it to be brought in. So it's not an overnight problem. You know, don't get hit by the bus you can see coming. You've got time to prepare. In terms of the pivot to new strategy, I think that's already been happening.
Yeah.
And I think, there's that sort of social housing, vulnerable tenant world. A few years ago, we used to see these, the type of Serco contracts.
Yes.
And there was a couple of challenger banks that would look at it and no one else really.
Yeah.
And now it's the norm. Now actual social
there.
housing, you know, subject to tenant profile and you know, a vacant possession clauses within the contracts. Actually, when it fits, it really fits. It's a great, credible stream of income and it makes a lot of sense. It's easy to back and support.
I think you're right. We're starting to see a lot more of it within market financial solutions as well.
Yeah.
Landlords with those big, larger properties looking to do something different. So let's just see how that works out and whether this how it works out through Lords, as you've said. Last couple of questions. Looking ahead, what market trends or shifts should brokers be keeping an eye on over the next 12 months?
I think a couple of things. I think there is still a rise in second charge mortgages.
Yeah.
And I think there's a common misconception that someone's going to put their hand up and ask for a second charge. I think, you know, we're lazy really. That's an industryism. That's not a public sort of colloquialism. So if we stop 10 people on the street and ask them what's a second charge mortgage, I think it's probably 1 in 10, maybe not even.
Similar to bridging.
Yeah, I think so. So I think if you're a good residential broker with a good residential back book, you've still got borrowers 3 years into a 5-year fixed on a good rate, where if they want to tap into equity in their home, which you would hope has appreciated in value, it's proactively reaching out and offering the opportunity to look at second charge rather than waiting for it to come to you. That's the one big market opportunity I think is still out there. And the second is not being scared of bridging finance.
Yeah.
Again, I think it's a misconception that bridging is expensive. That's the thing, right?
Always
bridging
has
is
been.
expensive.
Always has been.
But it rewards an organised borrower.
Yeah.
You know, you deliver, you execute your plan, and you get out early. You're paying for the months you're in the loan, not a full term. And actually, if it's led to a greater yield, greater return, or a sale, then it's worth it anyway.
The price is kind of irrelevant if the outcome is
Completely.
that great. I think you've ticked up quite a few answers to my last question here. But if a broker wants to be successful and evolve in the specialist market, what 3 things should they be doing?
Get in the detail early.
Yeah.
I think pick up the phone. Don't rely on rate card is the big one. And don't be afraid to ask questions. I think, you know, we still, as a firm, and, you know, I'm a decade in with this company in this industry, but I see stuff on cases now that I've not encountered before.
Yeah.
And I think that's probably true of everybody,
Yeah.
industry stalwarts included. So actually go and ask someone who might know, go and ask the question and find
Absolutely.
out and learn. There's so much to be done in specialist lending. It's a good environment to embrace.
Yeah, absolutely. Well, Joe, thank you very much for your time. That concludes my questions, and all the best for the future.
Thanks for having me.
Thank you. If you enjoyed this episode, please don't forget to subscribe, rate and share it. You can access our previous episodes in all the usual places, as well as on our website at www.mfsuk.com/podcast. You can also stay connected with us on Instagram at @MFS_LTP. See you next time.